welcome to the Money Show on ET Now with me, Snehi Shah. This is your one-stop destination for all personal finance queries. Now, we have lined up a power-packed show for you. First up, we will be joined by Vinay Paharia, the CIO at PGIM India Mutual Fund, on our special segment, Know Your Fund Manager. He will be talking about PGIM's investment strategy and the sectors they like. And in the second half of the show, we will throw open the counter to get your mutual fund portfolio queries answered by our expert of the day, Amol Joshi, founder at Plan Rupee Investment Services. So do send us your queries on our WhatsApp number 865-797-4571, or you can also email us your queries on the Money Show at etnow.tv. With that, let's kickstart the show with Mr. Paharia. Good evening, Mr. Paharia. Thanks so much for joining us today. Help us understand your view across sectors. Now, we have seen some froth in the mid and small cap space recently. The market is now also rediverting its attention towards large caps. So, talk to us about your view on the valuations that the stocks across these three categories are trading at, and what's your view when it comes to valuations?
Okay, I would like to be a little bit more explanatory on this because there is a lot of confusion as far as markets and valuations are concerned. So first, as you asked me about the overall valuations, we don't think so that large caps are trading at a significant premium valuations today. They are trading very close to their current fair valuations. So clearly, there is no signs of froth in large caps. Having said that, generally, when I look at mid caps and small caps, these are trading at significantly higher than their historical valuations, and hence clearly there seems to be a lot of premium valuations which is getting built into this space of the market. But I think there is something much more deeper than what is visible on surface as far as mid cap and small cap valuations are concerned. I think what we have done is we have divided the overall market in terms of quality and growth companies. And what we observe is that good quality and high growth companies have actually significantly underperformed the overall market, whereas weaker quality and low growth companies have significantly outperformed the markets in the last 1 year. And I think that is where we think there is a significant froth which is building up. And in terms of good quality and high growth mid caps and small caps, they are still available at reasonably good valuation. So I think we need to differentiate between the type of companies which are enjoying valuations. And I think, as I said, there is clearly a lot of froth in poor quality and low growth mid caps and small caps.
All right, well, point taken. Now tell us, which sectors are you liking at the moment? Which ones are you overweight on, and what's the rationale behind it?
So I can talk about our house views across sectors and how do we look at those sectors, and maybe that would help your viewers understand the current outlook on those sectors. So currently we are overweight sectors like financials, healthcare, consumer discretionary. In terms of financials, we are broadly overweight good quality private sector banks, NBFCs, and some very select non-lending financials. And the reason there is clearly that there is very strong growth visibility. The valuations are reasonable. There are certain challenges in the near term, largely related to deposit growth. But I think those are more supply side challenges and would be taken care of over a period of time. But clearly, the demand remains very strong. The overall NPA cycle or the credit costs remain extremely low. And I think that's one of the big reasons the returns on equities of most of the good quality financials are very strong and are available at reasonable price. So that's a sector one which we like a lot. The second one is the healthcare sector. Once again, this is a sector, as you rightly highlighted, it's underperformed this year, but this is a sector which has got very strong growth outlook. The outlook is, in terms of growth, it's very sustainable. Most of the companies which we like in this sector are having very high returns on equity. And in terms of sub-sectors within healthcare, we like healthcare services, predominantly the Indian hospital space, and we like domestic branded formulations. So these are broadly two sub-segments of healthcare where we are very positive on. And the third sector where we are very positive is the consumer discretionary space. This is a very broad sector. It includes a lot of other sub-segments, but the common thread which lies across all of them is they are all related to direct consumption, be it quick service restaurants, be it automobiles, so on and so forth. So this sector has high elasticity of demand versus staples. And since we think that Indian per capita income is seeing a Jacob effect, clearly this is a sector which is likely to see a significant rise in demand going forward. And most companies, once again, in this sector have very high return on equity, high potential growth, and have got very strong moats around their business. And hence, it's not very easy to replicate the businesses which these companies have created. So I think this is once again a sector which we are very positive on.
All right, so overweight on financials, healthcare, and consumer discretionary. But Mr. Paharia, also share with our viewers the sectors where you see some challenges playing out, sectors that PGIM is currently underweight on as a house.
In terms of sectors which we are underweight, we are broadly underweight the IT sector. This is a sector which is currently facing a lot of global macro demand headwinds, and there is uncertainties. There are certain disruptive forces in the form of artificial intelligence, whether it could displace some of the services which Indian IT companies render, so on and so forth. And hence, broadly, this is a sector where we are a bit more cautious. Yes, the sector has got a lot of good quality companies. Historically, they've grown well, but on a forward basis, we are a little bit more cautious in this sector, and hence we are broadly underweight the IT sector. And the other two sectors where we are underweight are energy and materials, largely because these are sectors which are dominated by commodity companies or companies which have got lower differentiation between the players, and hence their right to win and their right to earn substantially higher returns on equity is pretty low over a long period of time. Also, the underlying growth which these companies display is much lower, and hence we are underweight both energy and the materials space.
Well, we've seen some regulatory concerns emerging over the small and mid-cap schemes over the last few weeks. The market regulator too highlighted a few of these. So, Mr. Paharia, what's your view when it comes to the SMIDs, as we popularly call the space?
Once again, I would not want to comment on individuals' asset allocation because that is the full-time work of a experienced financial advisor. He's been trained to allocate capital. But as an investor, when I look across the entire space, I just want to highlight a few things. I think what we are trying to do is bucket the entire market into just three segments: large cap, mid cap, small cap. I think that is a very big problem because the challenge is not between just large caps, mid caps, small caps. The challenge is between low quality and low growth small caps and mid caps, and low quality and low growth large caps also. So I think it's about the bucketing. Clearly, there is a bubble like which is brewing in lower quality small caps and mid caps, which is what we have been highlighting. And I think we have been highlighting it since the last 6 months and not now, that there is clearly a material outperformance of low quality and low growth small caps and mid caps. And that is an area of caution. We have tried to sidestep that. And I think we would once again want to caution investors not to invest in low quality and low growth small caps and mid caps, or maybe in some cases some large caps which are low quality and low growth, which might be trading at expensive valuations. So I would just want to highlight that instead of bucketing the market into large, mid, small, it's also important to segment the market into in terms of quality and growth. And I think that is where you will see the starkness of valuation and the starkness of returns. So just to give you one more data point, in the last 1 year, uh, till 29th of February, uh, out of the top 500 companies in NSE or which are part of NSE 500, if I segment the market into three buckets, first one is good quality and high growth companies. Second is either good quality or high growth companies. And third is companies which have got poor quality and low growth. In the last 1 year, we have seen the high quality and high growth companies deliver approximately 30% lower returns compared to low quality and low growth companies. So I think that is what we are referring to. Over a 5-year and 10-year period, almost, and in fact, even in the last 20 years, we have clearly seen on a rolling 3-year basis, high quality and good growth companies significantly outperform the weaker quality and low growth companies. So I think that is what is what we want to communicate, that there is a clear challenge which is building up in the low quality and low growth companies of or the segments of the market. I think that's what I would want to highlight.
Viewers, with that, we'll slip into a very short break on this edition of The Money Show. We'll be right back with all your mutual fund queries, so you stay tuned.